The story begins in a place where most people never look, in the quiet space behind the movements of markets, where numbers drift like slow tides and decisions that seem distant eventually shaped the rhythm of ordinary lives. It is a landscape without loud announcements or dramatic thresholds, built instead on decades of quiet accumulation. When you step into it, you can feel how still everything appears on the surface, yet beneath that stillness, a vast current has been moving for a very long time. It is not the type of current that rushes forward all at once. It is the type that spreads little by little until one day it becomes the water in which everyone floats without realizing that the shore has disappeared behind them. As you settle into this unfolding narrative, each detail comes gently into focus, allowing you to understand how institutions grew large enough to influence the world without ever demanding attention. It helps to imagine the beginning as a series of small decisions made by millions of people who were simply trying to secure their futures. They placed their money in retirement funds, mutual funds, and index funds because doing so felt calm and responsible. No single contribution seemed important on its own, but together they formed a quiet river of capital. As the years passed, the river grew broader, feeding the growth of a small set of companies that specialized in managing this wealth. These companies did not need to be dramatic or charismatic. They simply needed to be steady. The steadiness itself became a magnet, drawing more capital toward them with each passing decade. When people feel uncertain, they reach for entities that seem calm, and the financial world is no different. The result was the gradual growth of two firms whose names would one day be spoken with a kind of reverence, or curiosity, or caution. The growth did not look like a conquest. There were no battles, no announcements of victory, and no single moment when everything suddenly changed. Instead, it was a slow accumulation, like sand settling at the bottom of a deep ocean. At first, the individual grains are barely noticeable, but over time, they create a foundation strong enough to hold immense weight. Vanguard and BlackRock expanded in this way by accepting the ordinary contributions of millions of people who were simply searching for a stable place to store their savings. The simplicity of the process made the scale feel almost invisible. Few people paused to consider what it meant for so much wealth to flow through so few channels. Fewer still wondered how influence grows when ownership becomes diffuse, yet consolidated through the same hands that guide the capital of countless individuals. When you look back at the origins of these firms, you see that they began with straightforward goals. Vanguard was formed with a structure that favored investors, built around the idea of minimizing costs and allowing people to keep more of what they earned. BlackRock began as a risk management firm, offering tools for understanding the movements of markets and protecting clients from uncertainty. These beginnings carried no hint of the influence they would later develop. They were simply solid, practical ideas that resonated with people who wanted reliability. The financial landscape at the time was scattered, filled with numerous firms offering similar services. No single firm dominated. The world seemed too large and too diversified for any one or two players to rise above all others. Yet, as the decades passed, subtle changes in the global economy created new opportunities. Companies expanded internationally. Capital flowed across borders more freely than ever before. Retirement systems in many countries shifted toward private investment accounts. As these structural changes unfolded, the firms that already possessed the deepest relationships and the most trust found themselves receiving more and more responsibility. It is easy to think that the rise of these giants must have involved some kind of secret strategy or a coordinated plan, but the truth is more understated. Their growth came from being in the right place at the right time, offering the right products, and inspiring a quiet confidence that spread from one investor to another. If you were to watch this progression from above, it would resemble a calm expansion of interconnected threads. Each fund they created linked them to hundreds of companies. Each investor who joined them connected those threads to millions of households. Over time, these connections formed a dense and intricate web. What makes this web remarkable is not its complexity, but its subtlety. It does not feel like a structure of control. It feels like a natural consequence of widespread desire for security. Yet security, when aggregated across decades, has a way of concentrating power in places where few people expect to find it. Vanguard and BlackRock did not seize this influence. It came to them because the world grew more uncertain, and people sought refuge in institutions that appeared strong and stable. The story unfolds like a whisper, revealing how influence does not always arrive through force. Sometimes it arrives through trust. Millions of people trusted these firms to look after their savings, and trust is a currency more powerful than any national bank can print. As trustees of enormous pools of capital, these firms gained the ability to influence corporate decisions without ever acting like traditional owners. They did not need to raid boardrooms or impose aggressive demands. Their influence came instead from the sheer weight of the capital they represented. When you own even a small percentage of nearly every major company in an economy, your presence becomes impossible to ignore. Companies listen, not because they are forced, but because the voice speaking to them represents a significant portion of their shareholders. This type of influence is unique. It is not loud, aggressive, or confrontational. It moves quietly through channels that most people never see. It flows through proxy votes, governance guidelines, and long-term investment strategies. It spreads through the simple fact that if you manage trillions of dollars in assets, you inevitably become a central pillar of the global financial system. By the time most people realized how large these firms had grown, they had already become essential components of modern markets. Their influence had woven itself into the structure of the global economy like threads tucked into the fabric of a tapestry. There is a softness to this kind of expansion, almost a gentleness. It does not overwhelm, does not disrupt in ways that draw public attention. Instead, it settles gradually, layer by layer, until one day the shape of the world reflects the quiet decisions of institutions that never sought the spotlight. Imagine standing at the edge of a lake. The surface looks calm, a mirror reflecting the sky above it. But at the bottom of that lake, currents move steadily, guiding the placement of sediment and shaping the contours beneath the waterline. Vanguard and BlackRock became those currents. They shaped the financial landscape, not through force, but through the persistent influence of capital that flowed toward them from every corner of the world. As their assets grew, so did the range of companies in which they held significant stakes. Technology giants, healthcare firms, industrial manufacturers, energy companies, telecommunications networks, consumer brands, and financial institutions all became part of their portfolios. This diversification was not intentional in the sense of seeking control. It was simply the nature of index-based investing. When you invest in the market as a whole, you end up owning a slice of almost everything. And when trillions of dollars follow that logic, the cumulative effect is immense. Without ever planning to, the firms managing those assets become central to the functioning of nearly every major corporation on Earth. What becomes clear as this story unfolds is that the growth of these firms represents a shift in how financial power works. In the past, power belonged to individual tycoons or families who owned large portions of industries. Their influence was visible, concentrated, and personal. In contrast, the influence of Vanguard and BlackRock is institutional, diffuse, and impersonal. It is built not on the ambitions of a single leader, but on the collective decisions of countless individuals who entrusted their savings to these firms. The result is a form of influence that feels almost organic, a natural consequence of millions of separate choices converging into a single stream. This convergence did not happen quickly. It took decades of quiet growth, countless small contributions, and years in which markets expanded, contracted, and expanded again. Throughout these cycles, the firms that offered stability continued to attract trust. People feel drawn to what feels reliable, especially when the world around them seems unpredictable. This is why the rise of these asset managers mirrors the psychological landscape of modern society. As people faced technological change, shifting job markets, and economic uncertainty, they sought reassurance in institutions that promised long-term consistency. The firms that could provide that reassurance became the anchors of global finance. Understanding this process reveals something fundamental about the way influence develops in the modern world. It does not always emerge from dramatic events or bold actions. Sometimes it develops from patience. Sometimes it grows from the accumulation of small decisions. Sometimes it forms through widespread desire for safety. This is how Vanguard and BlackRock came to hold such a central position. Their influence is not the result of domination, but of quiet acceptance by millions of people who wanted a reliable path into the future. As these forces settled into place, the world entered a new era in which financial influence became both vast and understated. The story continues from here, moving gradually toward deeper layers of how this influence spreads, how it shapes corporate behavior, and how it subtly guides the functioning of the global economy. Each step reveals a little more of the invisible architecture that supports modern life, allowing the narrative to unfold gently as you drift further into an understanding of the quiet power that rests beneath the surface of the world. The influence that emerged from this quiet expansion deepened as financial systems became increasingly interconnected, creating an environment in which the structure of ownership transformed in ways that were both subtle and profound. To understand how this happened, it helps to imagine the financial world not as a collection of isolated companies, but as a network woven from countless small threads. Each thread represents an investor, a pension fund, a retirement account, or a savings plan. On their own, these threads seem thin and delicate, but together they form a vast tapestry. Vanguard and BlackRock became the hands that gently guided the arrangement of this tapestry, not by force, but by serving as the channels through which the majority of these threads flowed. When index funds became popular, the relationship between investors and markets shifted in a fundamental way. Instead of selecting individual companies or trying to outmaneuver the market, people began placing their money into broad funds designed to mirror entire indexes. This approach was simple, cost-effective, and psychologically comforting. It required no expertise, no market timing, and no constant monitoring. It gave small investors access to the same types of returns that professionals pursued. Behind this sense of ease, however, another transformation was taking place. The firms responsible for managing these index funds slowly took on a role unlike anything the financial world had seen before. They became custodians of ownership, representing millions of people in ways that gradually reshaped the balance of power within corporations. Influence, in the traditional sense, relied on direct ownership. If someone wanted to influence a company, they bought a controlling stake or rallied other shareholders to their cause. Index funds changed this concept by turning ownership into something far more diffuse. The individual investor no longer owned a meaningful portion of any single company. Their stake was meaningful only in combination with the stakes of countless others. Since no one investor controlled how their shares were used in corporate voting, the firms managing the funds became the ones who exercised that power. This was not a deliberate consolidation of authority. It was simply a structural byproduct of how index investing operates. The manager of the fund must vote on behalf of the investors, and as more people joined these funds, the voting power became concentrated in the firms that managed them. This mechanism created a new form of influence that functioned quietly and efficiently, without the need for direct intervention. Companies began to recognize that the most significant shareholders present at their annual meetings were not individuals, but representatives of these asset management firms. When questions about governance or strategy arose, the views of these firms carried weight, not because they demanded it, but because they represented the interests of millions of investors whose money formed the foundation of modern markets. The firms themselves did not seek to act as puppet masters. Their influence was a natural consequence of their position, a reflection of how the financial ecosystem had evolved. As this structure became more pronounced, corporations found themselves operating in a world where they were perpetually observed by entities that owned substantial portions of their stock. This did not create tension. Instead, it created a form of stability. Companies realized that the long-term orientation of asset managers meant that they were not interested in short-term disruption. They valued steady growth, sound governance, and responsible management. This preference for stability shaped how companies approached decision-making, instead of responding to the demands of short-term shareholders or activist investors. Corporations increasingly found themselves aligning with the expectations of firms that represented broad swaths of the global population. This alignment created a kind of quiet equilibrium. The asset managers did not dictate strategies or micromanage operations. They simply encouraged practices that aligned with their understanding of long-term value. Over time, these preferences spread across entire industries, influencing everything from executive compensation to environmental policies. The influence was gentle, steady, and difficult to perceive from the outside. It did not resemble traditional control, yet it shaped corporate behavior in a way that became deeply embedded in the global economy. One of the most transformative developments in this evolution was the rise of passive investing. Passive funds do not attempt to outperform the market. They simply aim to replicate it. As more investors chose this approach, the landscape of financial competition shifted. Traditional active managers found it increasingly difficult to justify higher fees when passive funds consistently provided similar returns at a fraction of the cost. This led to a massive migration of assets from actively managed funds to passive ones. Vanguard, which pioneered the concept, became the primary beneficiary. BlackRock, recognizing the shift early on, expanded its offerings to include some of the most comprehensive passive investment products in the world. The shift toward passive investing created an environment where ownership patterns became stable and predictable. When a company is included in a major index, passive funds must buy shares to match the index composition. When a company leaves an index, passive funds must sell. These flows occur automatically, independent of any human judgment or analysis. This automation refined the nature of influence once more, creating a rhythm in which the largest asset managers guided the flow of capital simply by tracking indexes rather than by making discretionary decisions. As this process matured, the presence of these firms became woven into the structure of global markets. Their ownership stakes grew larger, not because they sought to accumulate power, but because the mechanics of passive investing made it inevitable. Investors who wanted simplicity and stability gravitated toward the same set of funds, and the firms that offered those funds became central pillars of the financial world. This centrality brought with it a unique responsibility. When trillions of dollars move under your stewardship, you become a stabilizing force, a source of calm in times of volatility, and a reference point for the behavior of corporations and investors alike. The influence that emerges from such responsibility is not loud or directive. It is anchored in the understanding that the fate of millions of investors rests on long-term stability. This awareness shapes how asset managers engage with companies under their watch. They prioritize sustainable growth, prudent governance, and risk management. Their influence spreads gently through conversations with corporate boards, guidance on best practices, and thoughtful voting on shareholder proposals. These engagements rarely capture public attention, yet they play a significant role in shaping corporate priorities across industries. Imagine standing in a large hall, filled with countless small lights. Each light represents a shareholder's voice. In the past, these voices flickered independently, each one small and distinct. With the rise of passive investing, the lights began to merge into clusters, and those clusters were carried by the hands of a few firms. The light itself did not change. Tamed, the voices did not lose their individuality. They simply flowed through new channels. The firms became the ones who carried the light forward, ensuring it illuminated the path for the companies they invested in. The quiet responsibility of carrying this collective light became a defining feature of modern asset management. This collective influence shaped not only corporate governance, but also the behavior of markets. When these firms adjust their portfolios, even in small ways, the ripple effects spread across the world. When they speak about risks, industries listen. When they encourage transitions toward more resilient business models, companies begin to adapt. This adaptation does not happen because these firms demand obedience. It happens because their perspective reflects the aggregated interests of millions of investors whose futures depend on steady and sustainable growth. Over time, this dynamic created a form of soft influence that permeates the financial world. It is soft because it does not seek to disrupt. It seeks to balance. It resembles the gentle pressure of a hand guiding a crowd through a narrow doorway. The hand does not push. It simply nudges in a direction that allows everyone to move smoothly. In the same way, the influence of asset managers guides companies toward decisions that align with long-term stability. It's helping them navigate challenges that might otherwise create upheaval. The evolution of this influence is closely linked to the way markets respond to global events. When crises arise, investors often turn to the same firms they have trusted for years. This influx of capital can be sudden and significant, further increasing the size and influence of the asset managers. The firms become refuges in times of uncertainty, absorbing anxiety and converting it into steady flows of capital. In moments when fear echoes through markets, the calm presence of these firms becomes even more pronounced. They provide the reassurance that long-term strategies will endure beyond temporary turmoil. As this pattern repeated itself across multiple economic cycles, the firms grew not only in size, but in symbolic significance. They became anchors in a sea of uncertainty, institutions that people trusted, even when they did not fully understand how the financial system worked. This trust, once granted, becomes a powerful force. It is the reason why asset managers influence the world even without seeking to control it. Influence flows naturally to those who are trusted, especially in environments where stability feels scarce. The transformation of Vanguard and BlackRock from modest financial institutions into systemic pillars did not unfold through dramatic gestures or sweeping declarations. Instead, it followed the same quiet trajectory that had guided their rise from the beginning, shaped by the choices of ordinary people and the shifting architecture of global finance. As the world became more complex, more volatile, and more interdependent, the desire for stability grew stronger. People began seeking institutions that seemed to offer clarity in a landscape filled with uncertainty. The firms that could provide that sense of clarity became woven into the fabric of everyday life in ways that most individuals never stopped to examine closely. When you look gently into this process, you can see how each step led naturally to the next, creating a path that seemed almost inevitable in retrospect. The story deepened during the decades when technology reshaped how markets functioned. Computers accelerated the speed at which trades could be executed. Algorithms analyzed data with increasing precision, and financial systems that once felt local became undeniably global. In this environment, the value of consistency grew. Investors wanted to feel anchored, and institutions that could offer broad, diversified exposure to markets became a preferred choice. It's the simplicity of putting money into a fund that mirrored the market felt both efficient and safe. This sense of safety invited more participation, and as participation increased, the firms that managed these funds expanded quietly in both scale and influence. As Vanguard and BlackRock grew larger, their role in global markets evolved in a way that was subtle yet transformative. The firms did not set out to become central nodes in the financial ecosystem. Their growth reflected the broad adoption of a model that promised cost efficiency and long-term alignment with market performance. The more people joined these funds, the more the firms became responsible for a growing share of the world's invested wealth. They became the stewards of retirement savings, university endowments, pension funds, and national investment accounts. Every new contribution reinforced their positions, and every market cycle strengthened the perception that they were reliable guardians of financial stability. This gradual accumulation of trust created a foundation that extended far beyond individual investors. Governments, regulators, and institutions began to recognize the significance of these firms in maintaining market order. Their portfolios became so vast and diversified that their stability was intertwined with the stability of global markets themselves. When you manage a portion of nearly every major company in the world, you become a central figure in the ongoing functioning of the economy. This interconnectedness does not feel like dominance. It feels like responsibility, okay? And it is this sense of responsibility that shaped how these firms approach their expanding role, okay? The transformation into systemic pillars did not involve bold assertions of authority. Instead, it grew from a continuous commitment to long-term thinking. In a world where market narratives often fluctuate between optimism and anxiety, Vanguard and BlackRock provided a steady presence. Their focus on diversified portfolios, low costs, and disciplined strategies attracted investors who wanted to avoid the turbulence of short-term speculation. This focus became a defining characteristic of modern asset management, influencing how other firms approached investment strategies and how investors perceived the value of stability. As their influence deepened, the firms began to interact more frequently with the companies held in their portfolios. These interactions were not intrusive or confrontational. They were deliberate, methodical, and anchored in the belief that long-term performance is tied to sound governance. The firms engaged in conversations about risk management, corporate structure, and sustainable business practices. They encouraged companies to consider the broader implications of their decisions, emphasizing the importance of resilience in an increasingly interconnected world. These conversations rarely made headlines, yet they played a meaningful role in shaping corporate priorities across industries. This process can be imagined as a gentle dialogue between capital and governance. The capital provided by millions of investors flowed into companies that relied on it for growth. In return, the governance decisions of those companies influenced the future returns of the investors. Vanguard and BlackRock became the intermediaries between these two forces, guiding the dialogue with a soft but steady hand. They did not demand compliance. They simply expressed the expectations of long-term investors whose interests they represented. This dynamic created a subtle yet powerful feedback loop in which companies adjusted their behavior to align with the steady presence of these firms. As the years passed, the influence of these firms extended beyond corporate governance. Their insights shaped broader market perspectives, especially during periods of uncertainty when economic conditions fluctuated. Their analyses and commentaries became reference points for investors seeking reassurance. Their long-term outlooks offered a calming contrast to the rapid swings of market sentiment. This calming effect had a stabilizing influence on markets, helping to smooth volatility during turbulent times. Investors found comfort in knowing that large, stable institutions were guiding the flow of capital with patience and prudence. This sense of stability spread far beyond financial markets. It seeped into the cultural atmosphere surrounding investment itself. For many individuals, investing ceased to be a speculative endeavor and became a pathway to long-term security. The presence of steady asset managers transformed the perception of markets from something risky and unpredictable to something navigable and even reassuring. This shift in perception played a major role in the continued growth of index-based investing. People felt confident placing their savings in the hands of firms that valued stability over speculation. And this confidence became one of the most important forces driving the expansion of these firms. As their assets grew, the operational scale of Vanguard and BlackRock reached unprecedented levels. Hundreds of funds, thousands of employees, and an intricate global infrastructure became necessary to manage the flows of capital and maintain smooth operations. Yet, despite this immense scale, the firms maintained an image of simplicity and accessibility. Their communication remained focused on long-term principles, cost efficiency, and the idea that investing could be straightforward rather than intimidating. This combination of vast complexity behind the scenes and approachable guidance on the surface created a unique bond between the firms and their investors. This bond, sustained over decades, helped transform the firms into something larger than the roles they once played. They became cornerstones of global finance, communities whose presence ensured that capital continued to flow smoothly even when the world felt uncertain. Their portfolios became reflections of the global economy itself, containing exposure to countless industries, sectors, and regions. In this way, they embodied the interconnectedness of modern markets. They became mirrors that reflected the diversity of the world's economic activity. Yet, their approach remained grounded in principles that prioritized stability and long-term outcomes. As the firms grew more central to the financial ecosystem, their internal practices evolved to support the scale of their responsibilities. Risk management systems became essential tools for ensuring that the portfolios remained balanced and aligned with investor expectations. Technological innovations allowed them to analyze market trends with increasing depth, identify potential vulnerabilities, and guide the allocation of capital with precision. Yet, despite these technological capabilities, the guiding philosophy remained unchanged. The firms continued to view themselves as stewards, not controllers. Their goal was not to direct the course of individual companies, but to safeguard the interests of the investors who had entrusted them with their savings. This stewardship role was not confined to corporate engagement. It extended into how the firms interacted with governments and regulatory bodies. Their insights into global markets, shaped by the vast amounts of data they analyzed, made them valuable contributors to discussions about financial stability. Policymakers sought their perspectives during crises, recognizing that the health of the financial system depended in part on the stability of the asset managers that held large portions of market capital. The firms responded with caution and care, aware of the delicate balance they needed to maintain between influence and responsibility. As their prominence grew, conversations about the role of these firms became more widespread. Some observers expressed concern that such concentration of influence could lead to an imbalance in the financial system. Others saw the firms as stabilizing forces that helped to protect investors from volatility. The truth lay somewhere in between, shaped by the unique position these firms occupied. They were not regulators, yet their decisions had regulatory implications. They were not owners in the traditional sense, yet their voting power shaped corporate governance. They were not governments, yet their influence was felt in economic discussions across the world. Despite these complexities, the firms continued to operate with a steady demeanor, focusing on their commitment to long-term value. This consistency provided a sense of continuity in a world that often shifted quickly. Investors found comfort in knowing that their savings were being guided by institutions that valued patience and stability. Corporations found reassurance in working with stakeholders whose goals aligned with sustainable growth. Policymakers found it useful to consult with firms that had a broad and balanced view of global markets. This multifaceted relationship reinforced the firm's role as systemic pillars. The influence that flowed through Vanguard and BlackRock did not expand in sudden leaps, nor did it announce itself with the type of forceful gestures that often accompany narratives of power. Instead, it spread through gentle and persistent patterns that shaped the corporate world from within. To understand how this happened, imagine walking through a large and quiet garden at dusk. The pathways are not marked. The air is still. Yet the arrangement of the trees and the subtle guidance of the lanterns ensure that you drift naturally along certain routes rather than others. This is how their influence took shape, not through overt direction, but through the architecture of expectations that formed around them. At the center of this architecture lies the way these firms interact with the companies they hold in their portfolios. Their stewardship model is built on the idea that long-term success depends on strong governance, balanced risk management, and sustainable strategic planning. They do not impose strict mandates. They do not interfere with day-to-day decisions. They instead express steady expectations through voting guidelines, letters to executives, and quiet conversations with boards. Over time, these expectations began to create a soft framework around corporate behavior. Companies learned that certain practices would be supported, while others would raise concerns among long-term investors. This process can be understood as a form of guidance that feels more like a steady hand on the shoulder than a commanding voice. When a company considers a strategic shift, it often anticipates the reactions of its largest shareholders, because these shareholders include asset managers that represent millions of people. The company's decision-making process naturally bends toward what these investors value. This does not mean companies surrender their independence. Instead, they adjust their priorities to align with a broader and more stable outlook. They began to see decisions not as isolated events, but as parts of a long-term continuum that must remain resilient through cycles of change. The soft architecture of influence also emerges through the way these firms engage in proxy voting. Every year, companies hold shareholder meetings where decisions are made about board composition, executive compensation, and various proposals that shape corporate policy. Since most individual investors do not attend or vote directly, the asset managers vote on their behalf. This responsibility is enormous. A single vote cast by an asset manager may represent the combined interests of millions of people whose savings are intertwined with the future of the company. The weight of these votes creates a calm but powerful pressure that encourages companies to act in ways that reflect not short-term desires, but long-term stewardship. The voting process itself is systematic and deliberate. The firms publish guidelines that outline their views on governance and sustainability, but they do not wield these guidelines as rigid demands. Instead, they use them as reference points for assessing proposals. Assessment relies on research, dialogue, and careful consideration of how each decision might affect the company's long-term trajectory. Because the firms own shares in thousands of companies across multiple industries, their approach must remain adaptable, consistent, and grounded in the principle that long-term success requires thoughtful governance. This consistency became a defining feature of how influence spread through corporate systems. Another layer of influence emerged through the role of board memberships. While Vanguard and BlackRock do not place their own employees directly on the boards of companies, they often engage deeply with directors. They encourage companies to select board members with diverse skills, balanced perspectives, and a clear understanding of long-term strategy. When boards reflect these qualities, companies become more resilient. They become better equipped to anticipate challenges, evaluate risks, and respond to shifts in global markets. This resilience benefits not only the companies themselves, but also the investors who rely on steady, long-term returns. The firms do not dictate which individuals should join a board. Instead, they offer guidance about the qualities that matter most. This guidance has a gentle but pervasive effect. Over time, companies across numerous sectors begin to adopt similar standards for board selection. These standards create a shared language of governance that connects firms across industries, shaping the corporate landscape in ways that enhance stability and reduce volatility. Beyond the boardroom, influence flows into strategic planning. When companies outline long-term goals, they understand that asset managers evaluate not only performance, but also the clarity of their vision. Companies that articulate coherent strategies earn confidence from these investors, while those that rely too heavily on short-term spikes in performance face more scrutiny. This scrutiny is not confrontational, okay? It unfolds through ongoing conversations where asset managers express concerns, okay? Ask questions and encourage companies to consider how their decisions align with long-term resilience. These discussions can shape corporate priorities subtly, yet significantly. Consider, for example, how companies address emerging risks. Whether the risks involve technological shifts, environmental challenges, or changes in consumer behavior, companies must demonstrate that they are prepared for long-term uncertainties. Asset managers often ask companies to describe how they plan to adapt, how they assess vulnerabilities, and how they maintain continuity during periods of change. These inquiries encourage companies to approach uncertainty with discipline rather than reaction, fostering strategies that remain stable even as external conditions fluctuate. Another aspect of influence flows through the concept of stewardship itself. The firms view their role not as owners seeking to assert control, but as guardians of the wealth entrusted to them. This sense of guardianship shapes how they communicate with companies. Their tone is measured, reflective, and focused on long-term value. They do not make demands. They ask questions. They explore risks. They encourage careful planning. This approach builds trust. Companies feel supported rather than threatened, and trust allows influence to spread in ways that feel natural rather than imposed. This trust has become one of the most important components of the soft architecture of influence. Companies across industries understand that Vanguard and BlackRock represent investors who care about sustainable progress. The firm's presence at the table reassures companies that they are being evaluated not on short-term performance alone, but on the strength of their long-term vision. This encourages leaders to make decisions that might take years to bear fruit, decisions that align with stable growth rather than fleeting spikes. The influence echoes through decisions about research, investment, operational improvements, employee development, and corporate culture. Perhaps the most subtle, yet far-reaching form of influence emerges from what the firms do not do. They do not attempt to micromanage companies. They do not impose uniform policies on every industry. Instead, they focus on the principles that support long-term value. These principles, transparency, accountability, strategic clarity, and risk awareness, become the foundation of corporate behavior. Because these principles apply across all sectors, they spread throughout the global economy like a quiet tide rising steadily against the shore. Corporations begin to internalize these expectations, shaping their internal processes accordingly. Annual reports become clearer, risk assessments become more thorough, and long-term strategies become more cohesive. These changes are not dramatic. The unfold gradually, integrated into everyday operations in ways that feel natural rather than obligatory. Over time, entire industries begin to move in similar directions, guided by the same soft expectations. The soft architecture also interacts with global collaboration. As companies expand internationally, they navigate different regulatory environments, cultural expectations, and economic conditions. Asset managers who operate globally offer valuable insights into these complexities. Their perspectives bridge regional differences, helping companies align diverse operations with consistent long-term strategies. This guidance fosters a sense of cohesion that enhances global stability. It helps companies maintain steady operations even when the world around them shifts unpredictably. Another dimension of influence arises through the development of best practices. Asset managers collect vast amounts of data on corporate performance, governance structures, and market trends. Over time, they identify patterns that correlate with long-term success. These patterns become the foundation for recommendations that spread quietly through the corporate world. Companies that adopt these practices often find themselves better prepared for challenges, more effective in their decision-making, and more trusted by investors. The influence does not remain confined to corporate governance. It extends into cultural expectations within the business world. As companies respond to the gentle guidance of asset managers, they begin to view their role in society differently. They start to consider not only profits, but also the broader impact of their decisions. This reflection emerges naturally from discussions about long-term resilience. When companies think decades into the future, they must consider the world in which they will operate. This consideration encourages them to adopt practices that support stability, sustainability, and harmony with the communities they serve. The soft architecture also shapes how companies communicate with investors. Over time, firms begin to adopt a more transparent tone in their reports, offering clarity about risks and opportunities. This transparency reduces uncertainty for investors and creates smoother interactions between companies and asset managers. It creates a feedback loop in which trust enhances stability and stability enhances trust. All of these elements intertwine to form a subtle influence that permeates industries without overwhelming them. The architecture is not rigid. It is flexible, adaptive, and sustained by the understanding that long-term success requires thoughtful governance and steady guidance. Vanguard and BlackRock became central to this architecture, not by seeking control, but by representing the interests of millions of investors who valued stability over speculation. Their role became embedded in the financial ecosystem through a gentle progression of expectations, conversations, and shared principles. The influence of Vanguard and BlackRock continued to expand as the world entered a period marked by rapid technological change, geopolitical uncertainty, and recurring waves of economic instability. These forces did not act independently. They intertwined, creating an environment in which the desire for stability became stronger than ever. In moments when the world felt unpredictable, investors gravitated toward institutions that seemed capable of withstanding turbulence. This instinctive search for calm strengthened the position of the firms that had already established themselves as pillars of long-term investing. The more uncertain the external world became, the more deeply their influence settled into the foundations of global finance. During times of crisis, the behavior of markets tends to shift dramatically. Investors retreat from risk, companies reassess strategies, and governments search for ways to stabilize economic conditions. These shifts create opportunities for influence to deepen, not because institutions seek to expand it, but because others lean on them for support. When millions of investors transfer their savings into safe and diversified funds, the asset managers who oversee those funds naturally become more central to the functioning of the system. Each inflow reinforces their role as stabilizing anchors, capable of absorbing vast amounts of capital and directing it into steady channels. One of the clearest examples of this dynamic occurred during periods of financial volatility that rippled across the globe. In those moments, many smaller funds struggled to maintain liquidity or lost investor confidence. By contrast, large asset managers with diversified portfolios and disciplined frameworks provided reassurance. Investors responded by shifting assets toward them, often quickly and in large volumes. These inflows were not motivated by ambition. They were expressions of collective instinct, driven by the desire for shelter in uncertain times. This instinctive behavior gradually concentrated more assets within the same institutions, reinforcing their central role in global markets. This consolidation was not designed as a power grab. It emerged naturally from the structure of modern finance, when individuals, governments, and institutions prefer stability over speculation. They gravitate toward the firms that embody that stability. Vanguard and BlackRock became symbols of predictability, institutions whose long-term strategies made them appear resilient even when markets fluctuated unpredictably. Their steady demeanor became a source of comfort, encouraging more investors to view them as safe harbors during turbulent times. As their assets grew, so did their responsibilities. A firm cannot manage trillions of dollars without becoming deeply involved in the functioning of financial systems. This involvement took many forms. In some cases, the firms served as bridges between markets and governments, offering insights based on vast data sets and decades of experience. In other cases, they acted as stabilizing forces within markets, ensuring that capital continued to flow smoothly even during periods of stress. Their influence was not imposed. It was drawn from them by the demands of a world that sought grounding in an era of uncertainty. One of the most important ways in which influence expanded during global crises was through the role of liquidity. Liquidity represents the ability to buy or sell assets without causing major price fluctuations. During volatile periods, liquidity can dry up quickly, causing markets to seize and investors to panic. Large asset managers, by virtue of their size and diversified holdings, often provided consistent liquidity when others could not. Their ability to maintain orderly operations during chaotic conditions allowed them to absorb shocks and minimize disruptions. This steadiness strengthened trust, encouraging more investors to view them as essential safeguards within the financial system. In addition to liquidity, the firms played crucial roles in interpreting market signals. When uncertainty rose, investors often struggled to distinguish between noise and meaningful information. Asset managers that communicated calmly and clearly helped anchor expectations. Their commentary did not attempt to predict dramatic swings or capitalize on panic. Instead, it emphasized perspective, encouraging investors to remain focused on long-term goals. This perspective spread outward, influencing how markets reacted to events. When millions of people follow the guidance of institutions that advocate patience, the collective result is a more stable market environment. Another dimension of influence emerged through the firm's role in global asset allocation, because they oversee funds that invest across regions and sectors. Their decisions help shape the flow of capital around the world. During moments of tension or crisis, these flows become even more significant. Steady rebalancing of assets, performed quietly and methodically, can stabilize entire markets. This rebalancing is not intended to guide governments or companies. It is simply part of the discipline required to maintain diversified portfolios, yet the effects ripple outward, affecting currencies, interest rates, and investment climates. As these processes repeated themselves across multiple crises, the firms became increasingly intertwined with the global pursuit of stability. Their presence became expected in moments of turbulence. They became part of the architecture that prevented panic from escalating into systemic collapse. This role did not elevate them into positions of authority. Instead, it placed them in positions of necessity. The world came to rely on their steadiness in ways that few people outside the financial world fully recognized. This reliance extended beyond markets. Governments and regulatory bodies often consulted these firms during periods of instability, seeking insights into the health of global capital flows, because the firms had visibility across thousands of companies in dozens of regions. They could provide a balanced perspective on trends that might otherwise seem chaotic. They did not dictate policy, nor did they seek to influence political decisions. Their role was informative, offering data-driven observations that helped policymakers navigate complex environments. This advisory presence created another layer of quiet influence, grounded in expertise rather than authority. While crises played a major role in expanding influence, periods of stability also contributed in subtle ways. During calm years, companies and investors looked to asset managers for guidance on long-term trends. As the global economy shifted toward digitization, renewable energy, and new industrial technologies, the firms encouraged companies to prepare for these transitions. Their guidance emphasized resilience, adaptability, and thoughtful planning. These themes resonated across industries, shaping strategic priorities in ways that felt natural rather than imposed. The influence also expanded to the growing importance of risk analysis. Modern markets depend heavily on data and analytics, and asset managers oversee some of the most sophisticated tools in the world for evaluating potential risks. These tools allow them to identify vulnerabilities before they become crises, offering companies and governments early insights into issues that require attention. When these insights are shared, they guide decision-making in subtle yet meaningful ways. They help shape how industries prepare for technological disruption, environmental challenges, and shifting consumer expectations. One of the most gentle yet profound forms of influence arose through the firm's ability to frame risk in long-term terms. Many investors focus on short-term fluctuations, reacting quickly to news or market movements. Asset managers, however, often emphasize the idea that risk must be understood over decades, not weeks. This perspective encourages companies and investors to adopt a calmer and more deliberate approach. It softens the emotional reactions that can destabilize markets and create space for thoughtful decision-making. This long-term approach influences global behavior in ways that extend far beyond finance. It shapes how companies innovate, how governments plan infrastructure, how universities manage endowments, and how individuals save for retirement. The influence is not directional. It does not tell people what to do. It simply offers a perspective that slowly becomes absorbed into the collective mindset that patience is a form of strength, that stability arises from discipline, and that long-term thinking creates resilience. As geopolitical tensions grew in various parts of the world, the firm's global presence became another source of influence. They manage assets in countries with very different histories, political systems, and economic structures. This diversity requires them to maintain a balanced perspective that is not tied to a single ideology or national interest. Their role becomes one of navigation, seeking opportunities across regions while managing risks with care. This balanced presence creates a sense of neutrality that companies and governments value. It allows the firms to serve as bridges between different economic spheres, fostering stability even when political relationships become strained. The more interconnected the world became, the more important this bridging role grew. When countries faced tension or uncertainty, companies often looked to their largest investors for reassurance. Asset managers responded with calm analysis and steady guidance, encouraging companies to focus on fundamentals rather than external noise. This approach helped prevent uncertainty from becoming destabilizing, reinforcing the value of long-term thinking in a world that often moves quickly. Over time, the combined effects of crises, stability, global expansion, and technological change shaped the quiet influence of Vanguard and BlackRock into something far more encompassing than simple asset management. Their role became that of stabilizers, interpreters, and long-term guides. They did not direct the world. They helped it maintain balance. The influence that emerged from this role was not forceful or centralizing. It was soft, steady, and woven into the background of the global economy. The influence that grew around Vanguard and BlackRock did not reside solely in markets or in the architecture of corporate governance. It also seeped quietly into the psychological landscape of modern life. This influence was diffuse, subtle, and often unnoticed. It shaped the way people understood security, stability, and the future. As the world became increasingly complex, the presence of institutions that seemed steady and reliable created a kind of collective reassurance. Even individuals who did not fully understand how markets worked felt comfort knowing that their savings rested within structures designed for long-term resilience. This comfort shaped their expectations, softened their fears, and guided their decisions in ways that gradually altered the broader cultural atmosphere surrounding finance. To understand this psychological dimension, imagine the feeling of watching a familiar lighthouse on a distant shore. You might not know who maintains it or how it operates, but its steady glow offers reassurance in the dark. The presence of large asset managers functioned in a similar way. They became part of the background scenery of modern financial life, constant and dependable in a world that often felt unpredictable. This dependability influenced how people thought about risk, how they approached long-term planning, and how they perceived the stability of global systems. The influence developed gradually, shaped by the rhythms of everyday experiences. Individuals contributed to their retirement accounts each month, often without giving much thought to where the money went. They saw their quarterly statements or watched the steadily rising line in their online accounts, associating that sense of prolonged upward motion with stability. This perceived stability calmed the anxieties that might otherwise accompany thoughts of the future. People began to believe that long-term saving was not only possible, but reliable. The confidence they placed in their own futures became intertwined with the firms that managed their savings, creating a subtle emotional connection between personal well-being and institutional stability. This emotional connection extended into perceptions of market behavior. When markets fluctuated, individuals might feel concerned, but the presence of large asset managers acted as a psychological buffer. These firms communicated with messages of patience, long-term focus, and disciplined strategy. Their tone was calm, measured, and devoid of panic. This tone influenced the mood of investors, helping them maintain a steady outlook even when broader narratives grew tense. The idea that someone was watching over their investments with a deliberate and thoughtful approach provided emotional grounding, reducing the fear-driven decisions that often destabilize markets. Over time, the presence of steady institutions created what could be described as a cultural expectation of stability. People began to assume that markets would correct themselves, that downturns were temporary, and that long-term growth was not only possible, but likely. This expectation did not arise from blind optimism. It came from decades of observing how disciplined management of diversified portfolios smoothed the rough edges of financial turbulence. This perception shaped how individuals planned for retirement, how families saved for education, and how professionals approached their financial futures. The psychological influence also extended into how people viewed the broader economy. News about global tensions, economic slowdowns, or shifting industries might create momentary anxiety, but the underlying presence of institutions that managed vast and diversified pools of capital offered reassurance. Even when the world appeared uncertain, individuals could sense that their money was connected to something stable. This sense of connection shaped how people interpreted risk. It allowed them to approach volatility with a type of emotional distance that might not have been possible otherwise. The influence expanded further through the narratives surrounding long-term thinking. Asset managers consistently emphasized the value of patience, discipline, and incremental progress. These themes resonated not only in financial contexts, but also in broader cultural settings. People began to internalize the idea that stability comes from consistency rather than impulsiveness. The emphasis on long-term planning influenced how individuals set goals, how companies structured their strategies, and how institutions approached decision-making. The message that patient growth outperforms quick gains became a quiet refrain throughout society. This emphasis on patience shaped how people responded to uncertainty. When confronted with unsettling news, individuals learned to pause rather than react. They considered the broader context, the long arc of time, and the resilience of diversified structures. This mindset, gently encouraged by the tone and behavior of asset managers, helped to create a more resilient psychological environment. The ability to maintain calm during uncertainty became a subtle form of strength, and this strength fed back into markets, reinforcing the stability that had given rise to it in the first place. Another layer of psychological influence emerged from the widespread perception of invisibility. The presence of these firms was everywhere, yet rarely discussed openly. Most individuals did not know the details of how the firms operated, which made them feel distant and abstract. This abstraction reduced fear. People often feel more anxious about entities they perceive as intrusive or aggressive. But when influence operates quietly behind familiar structures like retirement accounts and index funds, it becomes easier for individuals to accept without resistance. The very invisibility of influence became part of its calming effect. It allowed people to feel supported without feeling controlled. This sense of invisible support can be compared to the feeling of a sturdy foundation beneath a home. Most people do not think about the foundation daily. They do not examine it or study its structure. Yet they trust that it will hold the house steady through storms, heat, and time. Asset managers became part of the foundation of modern financial life. Individuals felt reassured by their presence without needing to understand the intricacies of their operations. The firms became background constants, part of the underlying structure that supported personal and collective expectations of stability. The influence also touched the way individuals interpreted wealth itself. For many people, wealth was no longer something held in physical form or stored in personal accounts. It existed as part of a collective pool, intertwined with the wealth of millions of others and guided by institutions that represented long-term interests. This collective understanding of wealth introduced a sense of shared destiny. Individuals realized that their financial futures were tied to broader systems rather than isolated circumstances. This awareness softened the individualistic view of money and introduced a more interconnected perspective. People began to think of their financial well-being as part of a larger, global flow of capital. This interconnected perspective encouraged a mindset of shared stability. Individuals understood that their own financial security depended on the stability of the companies, industries, and countries that formed the backbone of global markets. This awareness fostered a subtle sense of global empathy. People began to care, perhaps quietly, perhaps unconsciously, about the well-being of systems that extended far beyond their immediate surroundings. The psychological bond between personal security and global stability created a gentle alignment of interest that encouraged cooperation rather than conflict. The influence also shaped how people perceived the future. In earlier decades, the future often felt unpredictable. Careers changed, industries rose and fell, and global events could shift the course of economies overnight. Yet, as asset managers provided long-term frameworks for investing, the future began to feel more navigable. The idea that one could build a stable financial life through steady contributions and diversified portfolios became a comforting narrative. This narrative offered a sense of direction that soothed anxieties and encouraged individuals to adopt a more patient and confident relationship with time. This relationship with time influences daily life in subtle ways. People who trust in the long-term arc of their financial plans tend to make calmer decisions. They spend with more clarity, save with more consistency, and plan with more intention. This clarity spreads into other areas of life. Confidence in long-term stability encourages individuals to pursue careers, education, or personal goals with less fear of sudden collapse. It encourages families to plan for the future with optimism rather than apprehension. As this psychological framework took hold across large portions of society, the influence of asset managers extended beyond finance and into the collective emotional atmosphere. Their steady presence became part of the cultural rhythm. People discussed market downturns not with panic, but with a calm acknowledgement that such fluctuations were natural. They spoke about retirement savings as long-term journeys rather than immediate concerns. This collective calm contributed to a more stable environment, reinforcing the same sense of stability that had originally given rise to it. Over time, the relationship between individuals and the institutions that managed their wealth became a quiet partnership. People entrusted their savings to these firms. The firms responded with a philosophy of stewardship that emphasized discipline, patience, and resilience. This partnership shaped not only financial outcomes, but also emotional experiences, guiding people toward a more peaceful relationship with the uncertainties of life. The interconnectedness that formed around Vanguard and BlackRock did not emerge through deliberate construction. It arose through decades of gradual alignment, shaped by the decisions of corporations, governments, and institutions that increasingly relied on the stability offered by these firms. What began as simple investment management evolved into a dense network of dependencies that stretched across continents and industries. Each connection was subtle, created through shared interests rather than directives, yet together they formed a web that supported much of the modern financial world. To understand how this network works, imagine watching the gentle movement of constellations in the night sky. Each star shines independently, but the invisible lines that link them create structures that guide navigation and shape the way we interpret the heavens. The same quiet structure emerged in global finance, linking diverse entities into a coherent and mutually reinforcing system. At the heart of this network are corporations of every size and sector. These companies rely on investors for the capital needed to fund operations, expand into new markets, and weather periods of difficulty. As more investors move their money into index funds and long-term investment vehicles, corporations found themselves increasingly owned by the same handful of asset managers. This overlap did not restrict corporate autonomy. Instead, it created a shared foundation. Companies understood that these asset managers valued long-term stability above short-term volatility. They recognized that their largest shareholders represented millions of people who depended on consistent performance. This understanding shaped corporate decision-making in ways that aligned with the broader interests of investors. The influence of asset managers extended further through the interactions between companies within the same industry. When multiple firms in a sector share significant investors, they often end up sharing similar expectations about governance, risk management, and strategic planning. This shared foundation does not erase competition. Rather, it creates guardrails that help companies navigate the complexities of modern markets. They compete on innovation, efficiency, and creativity, but they do so within a structure that prioritizes sustainability and long-term value. This structure reduces the likelihood of destructive competition and encourages companies to focus on strengthening their core capabilities. Beyond corporations, the influence of asset managers touches governments in subtle yet important ways. Governments rely on stable financial markets to support economic growth, manage public debt, and maintain confidence among citizens. When asset managers represent large portions of national and global wealth, their perspectives matter during discussions about financial stability. Policymakers often consult them to understand market reactions, anticipate risks, and assess the health of various sectors. These conversations are grounded in data rather than ideology. Asset managers offer information drawn from vast and diversified portfolios, giving governments a clearer view of the landscape. This information shapes policy decisions, not through directives, but through the clarity of insight. This dynamic creates a quiet interdependence. Youths benefit from the stability that large asset managers help maintain, and asset managers benefit from policy environments that support long-term growth. Neither party seeks to dominate the other, They simply recognize that their goals are aligned: stable markets, healthy economies, and predictable long-term outcomes. This mutual reliance strengthens the network, creating a sense of shared stewardship over global financial systems. Institutions such as universities, pension funds, nonprofits, and insurance companies form another layer of this interconnected structure. These institutions often entrust significant portions of their endowments or reserves to large asset managers. In doing so, they tied their futures to the same long-term frameworks that guide individual investors. Universities depend on steady returns to fund research, scholarships, and infrastructure. Pension funds rely on consistent growth to meet their obligations to retirees. Insurance companies use long-term investments to balance risk across decades. By working with asset managers that emphasize stability, these institutions gain confidence in their ability to fulfill their missions. even in uncertain environments. This confidence creates another form of influence. When institutions feel secure, they make decisions that reflect long-term thinking. Universities invest in multi-decade projects. Pension funds plan for generations. Nonprofits commit to sustained initiatives. These decisions ripple outward, shaping communities, industries, and social systems. Its calm stability offered by asset managers enables institutions to act with purpose rather than fear, reinforcing the collective resilience of the network. The interconnections among corporations, governments, and institutions also extend across borders. Because large asset managers operate globally, they link diverse economies into a coherent ecosystem. Capital flows from one region to another in search of growth and opportunity, guided by long-term strategies that transcend national boundaries. This flow helps stabilize emerging markets, support infrastructure projects, and foster international cooperation. Countries that might otherwise struggle to attract investment gain access to global capital through the diversified portfolios of asset managers. This access reduces volatility and encourages local development. In this way, asset managers become bridges between economies. They connect regions that differ in culture, language, and governance, creating channels for capital that support growth and stability. These channels do not eliminate local challenges, but they help cushion the impact of global shocks. When capital flows steadily, companies can innovate, workers can stay employed, and governments can maintain essential services. This global connectivity becomes a quiet force that strengthens the resilience of entire regions. Another aspect of interconnectedness emerges through shared accountability. When asset managers engage with companies about governance or risk management, they often encourage consistency across industries and geographies. This consistency creates a sense of alignment that extends beyond national borders. Companies in different countries begin to follow similar standards for transparency, reporting, and long-term planning. These standards are not imposed by regulation. They arise from the shared expectations of investors who participate in global markets. As these expectations spread, they form a soft framework that guides corporate behavior worldwide. The network also deepens through the alignment of information. Asset managers gather enormous amounts of data about economic trends, corporate performance, market sentiment, and global risks. This data becomes a valuable resource for companies, governments, and institutions. When asset managers share insights through reports, dialogues, or consultations, they help create a shared understanding of the financial world. This shared understanding reduces confusion, aligns strategies, and fosters cooperation. It allows diverse actors to operate with a unified perspective, even when their interests differ. Within this network, the influence of asset managers remains soft rather than forceful. They do not dictate decisions. They illuminate risks. They highlight opportunities. They offer long-term perspectives. These offerings allow others to make informed decisions that align with stability. The influence arises from trust rather than authority. Companies trust that asset managers want sustainable growth. Governments trust that their insights reflect broad and balanced views. Institutions trust that their long-term interests are safeguarded. This trust forms the essence of interconnected influence. It is the invisible thread that binds the network together, allowing it to operate smoothly even during periods of strain. Without trust, the network would fray. Companies might resist guidance. Governments might ignore warnings. Institutions might withdraw from long-term planning. But because trust persists, the network remains coherent, adaptive, and resilient. The interconnectedness also shapes global attitudes toward risk. When large portions of the world rely on the same long-term frameworks, they begin to view uncertainty through a similar lens. They understand that risk is not something to eliminate, but something to manage with discipline. They recognize that stability comes from diversification rather than concentration, from patience rather than haste. This shared perspective softens panic during crises and reduces the likelihood of extreme reactions. It encourages societies to respond to challenges with a measured calmness that supports recovery. This calmness plays a crucial role in supporting global stability. When companies, governments, and institutions respond to challenges with steadiness, the ripple effects reduce volatility across markets, industries, and communities. This steadiness creates space for reflection, adaptation, and growth, allows global systems to absorb shocks, recover, and continue evolving. The influence that supports this calmness is gentle, pervasive, and sustained by the interconnected structure that asset managers help maintain. As this narrative continues, it moves into the ethical dimensions of this interconnected influence, exploring the fine balance between stewardship and dominance, and considering the questions that arise when quiet stability evolves into systemic significance. The next part examines the debates surrounding transparency, responsibility, and the delicate boundary between guiding and governing in a world shaped by soft power. The quiet influence shaped by Vanguard and BlackRock did not spread without raising questions. As their presence deepened across markets and institutions, thoughtful observers began to reflect on the balance between stewardship and dominance. This reflection did not erupt in accusations or conflict. It emerged through calm discussions about responsibility, transparency, and the unique position these firms occupied within global systems. Their influence was soft, steady, and grounded in long-term thinking. Yet the sheer scale of their stewardship invited an exploration of the ethical dimensions of such quiet power. Understanding these dimensions requires a gentle and measured examination, not of wrongdoing or intent, but of the natural tension that arises when stability and influence become deeply intertwined. The first ethical question concerned transparency, because the influence of asset managers operated behind the scenes through proxy voting, corporate dialogue, and long-term investment strategies. Many individuals were unaware of how decisions were made on their behalf. K trusted that their savings were being managed with care. But they did not always understand the mechanisms that translated their investments into corporate influence. This lack of visibility created a subtle gap between perception and reality. The firms did not hide information, but the complexity of the systems they operated made it difficult for average investors to grasp the details. The firms responded to this concern by increasing their communication. They published voting guidelines, stewardship reports, and explanations of their long-term philosophies. These communications were designed not to justify power, but to illuminate the principles that guided their decisions. They emphasized that their goal was not to direct corporate behavior, but to ensure that companies remained stable, resilient, and aligned with the long-term interests of investors. Yet, even with increased transparency, the complexity of global finance meant that many people still perceived the influence of asset managers as distant and abstract. A second ethical consideration involved concentration. When a small number of firms represent the interests of millions of investors, questions naturally arise about the consequences of such consolidation. These questions were not accusations of wrongdoing. They were reflections on the structural realities of modern markets. People wondered whether the concentration of capital under a small set of institutions might create fragility, even if those institutions acted responsibly. They wondered whether too much reliance on a handful of firms might limit the diversity of perspectives within markets. Asset managers acknowledged these concerns and emphasized that their growth was not a result of consolidation strategies, but a byproduct of investor choice. Individuals, institutions, and governments chose to entrust their savings to these firms because they offered stability, low costs, and disciplined long-term approaches. The concentration reflected trust rather than ambition. Still, the firms recognized the need to approach their roles with humility, clarity, and awareness of their systemic significance. Another ethical dimension emerged from the question of influence itself. Even if asset managers did not seek to direct corporate behavior. Their size ensured that companies paid attention to their views. Some observers worried that this influence might stretch beyond stewardship and into governance. They asked whether asset managers should play a role in shaping policies related to the environment, labor, or social issues. They questioned whether the firm's long-term perspectives might inadvertently shape public expectations or corporate norms in ways that resembled guidance. These concerns highlighted the delicate boundary between guiding and governing. Asset managers responded by clarifying that their role was not to impose social agendas, but to assess risks that could affect long-term value. They viewed environmental practices, labor, stability, and ethical governance not as political concerns, but as components of risk management. Their conversations with companies focused on resilience, not ideology. They encouraged firms to prepare for future challenges, not to embrace particular social positions. This distinction helped maintain the neutrality expected of asset managers, but the complexity of these issues ensured that debates would continue. One of the most subtle ethical questions involved expectations. Investors often assumed that asset managers represented their personal views, when in truth, the firms represented their long-term financial interests. These interests sometimes aligned with personal beliefs, but not always. Some investors wanted asset managers to push companies toward certain social or environmental positions. Others wanted them to avoid those topics altogether. The firms navigated these divergent expectations by returning consistently to their core philosophy, long-term value. They reminded investors that their mission was not to express individual opinions, but to ensure sustainable financial performance over decades. This philosophy did not silence debate. It provided a foundation for it, and people discussed the appropriate role of asset managers in global conversations. They wondered whether the firms should take stronger positions on emerging issues or maintain a strict focus on financial performance. These discussions reflected the growing awareness that financial influence, even when gentle, touches many aspects of modern life. The conversations became part of an ongoing cultural reflection about the responsibilities of institutions that hold vast stewardship roles. The ethical complexity expanded further through the lens of global diversity. Asset managers operate across countries with differing laws, cultures, and expectations. So what one society considers responsible governance, another might view as intrusive. What one region regards as essential long-term planning, another might view as secondary. The firms had to navigate these differences with sensitivity, ensuring that their approaches respected local contexts while maintaining consistent long-term frameworks. This balance required patience, listening, and adaptability. Their global presence raised questions about neutrality, because asset managers invest in companies across many countries. They do not align with the interests of any single nation. This neutrality allows them to act as stabilizing forces, but it also invites reflection about the role of cross-border investors in local economies. Some observers appreciated the balanced perspective that global firms brought to local issues. Others wondered whether global perspectives might overshadow local priorities. Asset managers addressed these concerns by engaging with local regulators, understanding regional dynamics, and adapting their expectations to reflect regional realities. The dialogue about influence also touched on generational expectations. Younger generations, shaped by concerns about climate change, technological disruption, and social inequality, often wanted asset managers to take clearer stances on structural risks. Older generations, shaped by concerns about financial security and stability, often favored a more conservative approach that avoided social engagement. Asset managers navigated these expectations through a framework that focused on material risks rather than ideology. They emphasized that long-term financial performance depends on the health of the systems in which companies operate. Natural systems, social systems, economic systems. How their discussions with companies reflected this holistic understanding of risk. Some observers wondered whether this broad approach to risk management blurred the line between financial responsibility and social responsibility. The firms responded by clarifying that their purpose remained rooted in stewardship. They were not policymakers. They were not activists. They were not arbiters of social change. They were guardians of long-term investor capital, and their engagements focused on ensuring that companies were prepared for the future. This clarity helped maintain the balance between guidance and restraint. Another area of ethical inquiry involved the potential for systemic risk. When large asset managers hold shares in thousands of companies, their decisions, intentional or accidental, can influence markets. Observers questioned whether the interconnectedness of their portfolios could amplify shocks or create vulnerabilities. The firms acknowledged these concerns and invested heavily in risk management systems designed to reduce the likelihood of such scenarios. They built internal structures that prioritize stability, diversification, and caution. These systems became part of the broader architecture that helps ensure the resilience of global markets. The firms also faced questions about accountability. Because they represent millions of investors, their decisions carry weight. Some wondered how such decisions could be scrutinized or understood. Asset managers responded by publishing more detailed reports, offering more transparency into processes, and engaging in public discussions about their philosophies. They emphasized that accountability comes from clarity, not from authority, and that their role is grounded in service rather than command. Through all of these discussions, consistent theme emerged. The influence of asset managers is a natural consequence of shared systems, not a result of deliberate ambition. It arises from the trust of millions of investors, the interdependence of global markets, and the necessity of long-term thinking in an uncertain world. The ethical considerations reflect the complexity of this position, not wrongdoing. They reveal a world in which stability and influence coexist, requiring thoughtful reflection and ongoing dialogue. The future influence of Vanguard and BlackRock began to take shape long before most people realized it, woven quietly into the accelerating pace of technology, automation, and global integration. As markets evolved, the systems that supported them grew more complex, capable of processing vast amounts of information, detecting subtle patterns, and responding to shocks with increasing speed. In this environment, influence no longer depended solely on human judgment. It became intertwined with algorithms, data flows, and digital frameworks that reshaped the way capital moved around the world. The role of large asset managers adapted to these changes with the same soft steadiness that characterized every stage of their evolution, gradually expanding from stewardship into something more technologically interconnected. It's still deeply rooted in long-term thinking. To understand this transformation, imagine standing above a vast web of rivers and streams. In earlier decades, the flow of water represented the movement of capital, guided primarily by human hands, slower, more deliberate, and shaped by intuition. As technology advanced, sensors, gates, and automated systems were introduced into the waterways, allowing them to respond instantly to changes in conditions. The river still flowed naturally, but the infrastructure surrounding it grew more responsive. In the same way, the financial world did not lose its humanity. It simply gained tools capable of amplifying stability, identifying risk earlier, and smoothing the movement of capital across regions. One of the most significant technological shifts came from the rise of data analytics. Asset managers, who once relied on teams of analysts studying reports and trends by hand, began integrating advanced systems capable of processing millions of data points in seconds. These systems did not replace human judgment. Rather, they expanded the horizons of what humans could understand. Patterns that once took months to identify became visible almost instantly. Risks that might have gone unnoticed became detectable at early stages. Opportunities that existed only briefly could be evaluated with clarity. This enhanced awareness allowed asset managers to maintain stability in increasingly complex environments. The use of technology also improved portfolio management. Automation supported rebalancing processes, reducing errors, and ensuring that funds remained aligned with their intended strategies. These adjustments were made gently, maintaining the calm and steady approach that investors relied on. The increased precision did not make portfolios rigid. It made them more responsive to subtle shifts in global conditions, enhancing resilience without introducing volatility. The algorithms worked quietly in the background, always guided by the long-term principles set by human teams. As automation spread throughout the industry, asset managers became central to discussions about the future of global markets. The firms did not attempt to lead technological change, but their scale meant they played a natural role in shaping how new technologies were integrated into financial systems. They collaborated with regulators, technology companies, and institutions to ensure that innovation supported stability rather than disrupting it. This collaborative approach further strengthened their position as stewards of long-term resilience. The global economy entered a new phase as digitalization accelerated. Entire industries transformed. Supply chains became more complex, and the speed of information increased dramatically. In this environment, investors sought guidance on how to navigate the shifting landscape. Asset managers responded by developing strategies that accounted for technological disruption, encouraging companies to adapt without losing sight of long-term goals. Their influence helped smooth the transition into the digital era, reducing the anxiety that often accompanies periods of rapid change. As technology spread across borders, global integration deepened. Capital flowed more freely between countries, and investors gained access to markets once considered distant or inaccessible. Asset managers, already experienced in navigating diverse regions, became essential guides in this interconnected environment. Their ability to evaluate global risks and opportunities with balanced perspective made them central to the movement of capital across continents. It became bridges not only between industries, but also between countries at different stages of development. This bridging role allowed them to support global stability in new ways. When emerging markets faced volatility, steady investment flows provided by globally diversified funds helped cushion the impact. When developed markets encountered uncertainty, the presence of global capital helped maintain liquidity. In both cases, asset managers helped prevent localized turbulence from spreading uncontrollably. Their influence operated gently, supporting resilience without overwhelming local dynamics. Evolution of their influence also intersected with the growing importance of sustainability. As climate concerns and resource challenges became more prominent, long-term investors recognized that environmental risks could translate into financial risks. Asset managers responded not by adopting political positions, but by integrating scientific and economic data into their analyses. They encouraged companies to prepare for changes in natural systems, supply chain vulnerabilities, and regulatory environments. Their goal was not activism, it was risk awareness. This approach shaped corporate strategy across industries. Companies began evaluating the long-term sustainability of their operations, not because they were pressured to adopt ideological commitments, but because investors increasingly recognized that resilience required preparation for environmental challenges. These discussions helped companies anticipate shifts that would unfold over decades, reinforcing the same long-term mindset that had guided investment strategies for years. The future trajectory of influence also became intertwined with demographic changes. As younger generations entered the workforce and began investing, they did so with expectations shaped by technological fluency and global awareness. These investors valued transparency, accessibility, and digital ease. Asset managers responded by developing user-friendly platforms, offering clearer communication and adapting to the expectations of a new generation of savers. These changes strengthened the psychological connection between investors and institutions, helping the next wave of workers develop a calm and confident approach to financial planning. Another dimension of futuristic influence came from artificial intelligence. Tools allowed asset managers to simulate thousands of possible futures, stress test portfolios, and identify correlations that might otherwise go unnoticed. Yet, despite these capabilities, human oversight remained essential. The firms approached AI cautiously, using it as an enhancement rather than a replacement. The algorithms did not guide strategy, they supported analysis. This measured integration ensured that advanced technologies reinforced long-term principles rather than overriding them. As these technological layers accumulated, the influence of asset managers became more deeply integrated into the machinery of global finance. Not dominant, not commanding, but foundational. Their systems monitored markets with quiet precision. Their strategies absorbed volatility with calm discipline. Their perspectives bridged regions, industries, and generations. These interconnected capabilities shaped the direction of global capital, not through force, but through consistent alignment with the interests of millions of investors seeking stability. As the world looked toward the future, it became clear that influence would continue to evolve alongside technological and economic innovation. Markets would grow more integrated. Automation would enhance decision-making. Global networks would expand. Yet through all of these changes, the same long-term philosophy remained at the core of asset management. The principles of patience, diversification, and resilience continued to guide the movement of capital, providing a steady rhythm beneath the accelerating pace of the modern world. In this future environment, the role of asset managers resembled that of navigators rather than captains. They did not steer the world. They helped it avoid the rocks. Did not dictate direction. They illuminated safe corridors. Their influence remained soft, steady, and woven into the background like the quiet hum of a ship's engine, maintaining momentum while allowing the crew and passengers to focus on the horizon. The influence that spread quietly through financial systems, corporate structures, global networks, and technological landscapes ultimately settled into a place closer to everyday life than most people realized. It did not matter whether someone followed the markets closely or rarely thought about investing at all. The steady presence of long-term asset managers shaped the environment in which people lived, worked, planned, and dreamed. This influence had no sharp edges, no dramatic interruptions. It flowed through ordinary routines like a soft current beneath the surface of a calm lake, guiding the subtle movements of life without ever calling attention to itself. As this story comes to rest, it explores the gentle ways in which these quiet forces shape the world from the perspective of individuals who may never know the full extent of their presence. For many people, the influence began with something as simple as a monthly deposit. A small portion of a paycheck would enter a retirement fund, a pension contribution, or an investment account. The individual might glance at the numbers once or twice a year, feeling a sense of satisfaction as the balance rose. They did not always consider where the money went after leaving their account. They did not imagine it flowing into companies across the world, supporting industries they relied on daily. Yet, each deposit became part of a larger rhythm that shaped the stability of global markets. Each contribution, no matter how small, formed a thread in the vast tapestry that asset managers quietly guided. This connection between personal savings and global stability created a sense of security that permeated everyday decisions. People planned vacations, knowing their long-term savings were quietly growing in the background. Families made choices about housing, education, and careers with confidence that future resources would be available. This confidence did not come from promises or guarantees. It emerged from decades of steady performance, disciplined management, and the knowledge that millions of others were participating in the same shared system. This shared participation created a collective sense of reassurance that softened the anxieties often associated with the future. The influence also shaped how people interpreted economic news. Headlines about market shifts or global events, which might have triggered fear in earlier eras, now carried a softer tone. Individuals learned to understand that temporary downturns were part of a long-term cycle. They approached these fluctuations with patience rather than panic. They trusted that the systems guiding their savings were built for endurance, not for reaction. Okay? This shift in mindset influenced how society perceived risk. Okay? Risk became something manageable, navigable, and softened by diversification, rather than a looming force that dictated daily choices. In workplaces, the influence appeared in subtle ways. Companies, shaped by long-term investors, tended to prioritize resilience, innovation, and sustainable growth. These priorities created environments where employees could build careers over years rather than months. Workers felt more secure when companies focused on long-term planning rather than short-term gains. This stability influenced corporate culture, encouraging teams to think ahead, cultivate skills, and pursue goals that aligned with enduring value. In this sense, the soft influence of asset managers extended into professional life, shaping routines, expectations, and the atmosphere of work itself. Communities also felt the gentle effects of this influence. The investment decisions made by asset managers supported infrastructure projects, energy transitions, technological innovations, and services that people relied on daily. Roads were maintained, communication networks expanded, hospitals upgraded, and schools improved. These developments were not framed as the work of particular firms. They were invisible, woven into the slow and steady progress that defined community growth. The influence moved quietly through neighborhoods, touching daily life without ever placing itself at the center of attention. The presence of long-term asset managers also shaped how individuals felt about the broader world. Globalization often seemed abstract, described in terms of trade agreements and political alliances. Yet the experience of living in a globalized world was softened by the presence of financial systems that linked countries together. Individuals benefited from stable prices, accessible goods, and opportunities for travel, education, and work across borders. These opportunities were not the direct result of asset managers alone, but the stability they helped maintain played a role in sustaining the environment that made such experiences possible. In this interconnected world, the influence extended beyond economic stability. It touched psychological and cultural rhythms as well. People grew accustomed to thinking in terms of decades rather than days. Okay? They built habits around saving, planning, and envisioning futures that stretched far into the distance. Okay? This long-term perspective influenced how individuals approached challenges. Okay? They learned to weather temporary discomforts with patience, knowing that growth often unfolds slowly. Okay? This mindset echoed the same principles that guided asset managers: resilience, discipline, and calmness in the face of change. The influence also nurtured a sense of shared destiny. When millions of people invest in similar structures that support the global economy, their financial futures become interconnected. This interconnection fosters a gentle awareness that personal well-being is linked to the well-being of others. Individuals may not think about this consciously, but the feeling exists beneath the surface of society like the quiet hum of a distant engine. It encourages empathy, cooperation, and an understanding that stability is a shared responsibility. This subtle cultural effect helps strengthen communities, workplaces, and global relationships. The gentle influence of asset managers also shaped how societies adapted to long-term challenges. As environmental concerns grew more prominent, companies prepared for future transitions because their long-term investors emphasized the importance of resilience. This preparation influenced entire industries, including energy, transportation, agriculture, and technology. The changes unfolded gradually, guided by economic incentives rather than ideological pressures. This approach allowed communities to adapt at a pace that balanced innovation with stability, ensuring that transitions were manageable rather than disruptive. Technological transitions were softened in similar ways. As automation spread, companies, guided by long-term frameworks, invested in the training and development of their employees. They planned transitions with care, reducing the anxiety that often accompanies technological change. Workers felt more secure when companies demonstrated a commitment to adapting responsibly rather than chasing rapid transformation. These behaviors, though shaped by management decisions, were influenced by the expectations of long-term investors who valued sustainable progress over sudden leaps. The steady presence of asset managers also held a quiet influence over societal expectations of fairness. Because these firms invested broadly across industries, they encouraged companies to adopt transparent governance, responsible practices, and policies that supported long-term performance. These expectations created a soft cultural pressure for consistency and accountability. Over time, companies internalized these values, and they became part of the fabric of business conduct. This consistency helped shape a more predictable environment in which individuals felt respected and supported. The influence extended even into moments of uncertainty. During times of stress, economic downturns, geopolitical tensions, or global disruptions, individuals often sought reassurance in places they trusted. The continued stability of their savings provided a foundation of calm. The knowledge that their long-term plans remained intact helped soothe fears. The steady communication from asset managers reinforced this calm, reminding individuals that resilience comes from breadth, patience, and perspective. These reminders did not eliminate uncertainty, but they softened its edges, allowing people to face challenges with greater confidence. The cumulative effect of these quiet influences created a sense of continuity that shaped modern life. People moved through the world with an underlying trust that systems would hold, that progress would continue, and that the future, while unpredictable, could be approached with clarity. This trust did not come from blind faith. It came from decades of consistent behavior from institutions that had demonstrated their commitment to long-term stability. As individuals aged, they experienced the influence in different ways. Younger workers built habits around saving and investing. Middle-aged individuals balanced career decisions with long-term plans. Greed lived with confidence that their savings would support them across generations. The presence of steady asset managers provided a quiet backdrop for meaningful life choices, became a constant companion in the background of financial well-being, uncelebrated yet deeply important. In the final reflection, the influence of Vanguard and BlackRock appears not as a force that sought to control the world, but as a presence that helped it stay balanced. Their role in global systems resembles the quiet movements of tides. The tides do not command the ships that sail upon them. They simply provide the conditions that allow journeys to unfold. In the same way, these asset managers offered an environment of stability that allowed individuals, companies, and governments to pursue their goals with clarity and confidence. Their influence shaped the world gently, guiding decisions toward sustainability, encouraging patience, and fostering resilience. This influence did not diminish individual agency or collective creativity. It created the space in which both could flourish. The story of their quiet presence is a story of how long-term thinking, steady stewardship, and trust shared across millions of people can shape an entire era, not through dominance, but through calm endurance.